Hey there, hello, and welcome to Fundu Money, your 24 into 7 buddy for all your money matters. In this particular video, we're going to take up mutual fund questions, which our viewers send to us every week, and this is becoming hugely popular. We'll be taking up 5 questions. That's quite a lot, so we'll have to get started with the business very soon. So we'll be back with you with all the questions from our viewers. That's not all. There are many more questions that have come in, but that's coming up in just a little while. Welcome back. Welcome to Fundu Money, your 24 into 7 buddy for all your money matters. In this video, we are taking up questions related to mutual funds, which our viewers have sent. And there are obviously many more questions, but we are just taking as many as we can. And these are reasonably straightforward questions with straightforward answers. So we are taking up such questions in this particular video. There are 5 such questions which we are taking up in this video, and we'll try to give you a very quick answer. So let's take up the first question. That's by Aman Gupta. Aman Gupta is interested in investing in Bharat 22 ETF, and he's been wondering why he's not being able to do an SIP very easily. He's not being able to do the SIP at all. Now, Aman, the point is this, that ETF is like a share. You have to buy it through a demat account. So you have to take a demat account, open a demat account, and through a demat account, like a share, you have to buy it. And if you want to do it through an SIP, you have to do it regularly. You have to invest regularly, and that has to be done through a demat account. So it's exchange traded funds, or ETFs are like shares. They're listed on the stock exchange, and you buy and sell them like shares. So that's number one. Number two is Rohit Mishra. He's seen one of our videos on hybrid funds, and he wants to know whether it's the same as balanced funds. Well, Rohit, actually, the point is this, that balanced funds are like one subcategory of hybrid funds, where there are, when we are talking about hybrid funds, it's a mixture of assets in which investments have been done. So typically it's equity and debt. In some cases, it's a multi-asset sort of fund where gold or some other asset class could come in. But broadly, when we're talking about hybrid funds, we are talking about equity and debt, where the fund is investing in shares and also in debt securities. Now, what is the distinction as far as balanced funds are concerned? Balanced funds are typically, they're 65% or more are invested in equities. So as a result, what happens is when the stock markets are doing well, so you get a slightly higher sort of a growth than something a fund which is invested less in equities. Also, it's a tax distinction, because 65% or above is treated like an equity fund. What does that mean? That means if you're stayed invested for more than a year, all the capital gains that accrues to you, that comes to you, is there's no tax long term, because that's treated as long term capital gains. So there's no tax, nil. But if it's less than 1 year, then it's 15% short-term capital gains tax that's imposed on the capital gain. So that's as far as balanced funds are concerned, hybrid funds are concerned. MIP is another example of monthly income plan by mutual funds. That's another example of hybrid funds, but there the equity component is much lesser, about 20% or so. So hybrid funds it depends on the composition. I mean, the split between debt and equity. Hope this clarifies. Now let's take the next question. That's Amit Belwal. He's one of our regulars, and he says he wants to know whether one should buy dividend mutual funds. Are they useful? Now, the question probably needed a little bit more of elaboration. Now, there are two things that Amit could have asked. Now, we are guessing that he's asked about dividend plans, where you have a growth plan and you have a dividend plan. Dividend gives you from the gains that are happening in your investment. Regular payouts are happening. Dividends are being announced, and you invest in them because you want a regular sort of income. So that's a dividend sort of a plan. Now, you when you buy a dividend plan, typically when you want a regular income, or in the intervening period when you've invested, you want some income coming to you. That's when you do it. If you're sort of retired, or there's some other requirement for which you need a regular income, you take a dividend sort of plan. Typically, if you're going for a long-term goal, say retirement or child's higher education, you don't want that money to come back to you. You would want it all to be put back, all the gains to be put back, all the appreciation that's happening is to be put back into the scheme or your investment, and so that it keeps growing. So that's number one. But just in case, Amit was talking about dividend yield funds, which is completely different. The concept is completely different, where the equity fund is investing in dividend yielding stocks or dividend yielding equities. That's a different ballgame altogether. There are such funds which are dividend yield funds. They invest in high dividend yielding stocks, and they're typically useful when the markets are declining. They're going down, and the the equities, the appreciation might not be all that much. So what happens is, because these stocks give you dividend on a regular basis, so you know that the appreciation will keep happening. So dividend yield funds are typically quite useful in your mutual fund portfolio if you're getting into equity funds, and second, of course, the markets are not really doing that well, and it's sort of a declining market. So hope that answers Amit's question. Now let's take another question, which has come from Padma Kumar Patil. He wants to know why a cancelled check is required when you go for mutual fund investment. It's pretty straightforward, actually. The idea is to establish that the account that you're giving, the account details you're giving, actually is verified. So in a check, everything about yourself is written, the account, the fact it belongs to you, all the details can be verified. It's a physical evidence. So it's for security reasons. It's a pretty decent idea, so one should not be too bothered about it. So that probably would take care of this query. So let's move on to the final query that comes from Mukund Kulkarni. Now Mukund wants to know whether one should, how should one invest a lump sum amount, a large amount in ELSS, and which are the right funds which we think. Now, as you mentioned, systematic transfer plan is the way to go about it. They park that lump sum in a liquid fund or something which is low risk, high liquidity, and on a regular basis, in a scheme that you choose in the same fund house, they'll put in money out there. So, which are the three schemes? We have been mentioning this all along. You can check out in the ELSS playlist, but we'll quickly mention their names. That is Aditya Birla Tax Relief 96, Franklin India Tax Shield, and Access Long-Term Equity. For more details, you can check out all our ELSS playlists and some of the new ELSS videos that we'll be publishing. You can check them out and get some little more of information. And of course, you can always consult a financial advisor or a financial planner, somebody who will advise you and put you on the right side of things. So that takes care of the fifth query. So I'm afraid that's the time we have for these queries. We'll be back next week with another edition of Mutual Fund Q&A. Just in case you found this video useful and liked it, press the like button. If you've come here for the first time, why don't you subscribe to our channel? Apart from that, we are there on all leading social media networks, and of course, we are there on our site. That's www.fund2money.com. So till the next edition of our Mutual Fund Q&A, take very good care of yourself, and goodbye.